Okay, so I'm going to just give you a real quick example of a case study here and how I can see this translate into your group. The Illinois School District Cooperative, EBC, we established in 1984. So initially it was relatively small, 8 members of the organization, and now it's grown to over 81 districts. Actually, it's up to 85 now. And what we essentially have done with this group is there's 2 real ways to think of this association type plan, right? There is a trust or MIWA type of an approach, and then there's more of a discount that you can get from insurance companies based on the number of entities you have within an organization. So one of the things that we're speaking to Elliot about is what's the best way to set this up as we get more information in to better serve you. So the trust or MIWA would essentially be a situation similar to this where it's self-funded. Basically, the organizations are paying for the claims as they come in. If you think about the way that insurance is structured right now, a lot of you are probably paying it similar to like car insurance, right? You have a rate, you pay that rate based on the number of employees that you have on the plan every month. At the end of every year, it potentially can and usually does go up. The other way to do it would be to say we're going to actually pay for the claims that our members or our employees incur. And one of the reasons why this is not traditionally seen in the smaller group market is, let's say you have 3 employees, your costs are going to be a lot more volatile, right? Walmart knows what their healthcare costs are going to be over the course of a year, because even though it might not be the same group of employees that have big costs, they know it's going to be a different group. It's what they call underwriting credibility, right? And you start to get that once you get to that 1,000 employee threshold. Okay, so once we get to that level, it starts to get a lot more easier to say, all right, we have flexibility in how we want to structure this type of program. The other way, and the way that we've done it with some success as well in the past, is going to insurance companies with a group of organizations and say, all right, we have all these interested members, can we get some sort of discount off what your manual rate is? And that would be the other way to set it up. But as you can see here, the EBC has taken more of that self-funded approach where they're actually paying for the claims that they have come in. And the reason why it makes sense to kind of all band together is what you have is different levels. So the first $0 to $30,000 worth of claims that this entity has, each individual organization pays for that. Then over that, there's what they call a banding level, right? Where essentially all the claims that come in from $30,000 to $150,000 are all pooled together and then divvied up and shared across the whole population. Anything over that is then taken up by a reinsurance company. You pay a small fixed cost for it. Okay, so there's a wide variety of ways that you can kind of set this up. This is the historical rate adjustments for the EBC. You can see the last 5 years, 4.9%. It's pretty incredible, really, when you start to think about what this is. I mean, I'm hearing a little bit here. Can I see a show of hands of?
Yeah, most people have big double digit.
Yeah, exactly.
And I don't mean to portray this in a light that says this is a silver bullet. What this does do is, especially for the smaller organization, it really takes those large fluctuations and mitigates those. So it's basically a way to stabilize costs over the long run. When you're looking at trend, or what the insurance companies say the cost of medical insurance is every year, recently it's been a little bit higher. We're looking at like the 14% range. When you start to get down into the small businesses, those companies, like I said, if you're under 150 or under 100 based on whatever company you're with, they pool those all together within a certain area. But you can almost throw a trend out the window when you're looking at those organizations, because like I said before, there's not a lot of credibility to say, all right, you had 10 employees on your plan, 2 had conditions. That's going to be a huge bump to your plan as opposed to the group that has 1,000 employees and you know what their costs are going to be.
Have those relatively slight increases been in part the result of changes in benefit level, or is that apples to apples?
This is apples to apples. So basically what these numbers indicate are, this is the average as well. All right, so this is across 81 different entities. So what we've done is essentially said, all right, entity A, your costs are going to be 6.7% next year if you do nothing in July of 2006. The other part of this, though, that I think is worthwhile to discuss is what we typically do is banding formulas. Okay, so within those 81 entities, every group is going to have a different level of what their claims came in at, right? You're going to have those that had a terrible year, and normally outside this would have gotten, let's say, a 30% increase. And by contrast, you're going to have an entity that had, let's say, a great year. Let's say they added a bunch of new younger employees and some older employees came off the plan, and if they were outside on their own, they would, let's say, have a 5% decrease. What this does is essentially tries to push all that together and make sure that the 30% outside the pool doesn't get that 30%, and the negative 6%, it might not get negative 6%, but at least it's somewhat manageable and budgetable. Okay, so what we do then is say 70% of the group is going to get the 6.7% increase. Our next highest 20% utilizers are going to get 5% above this, and the next lowest 20% utilizers are going to get 5% below this.
So you still band within that?
Pardon?
So you still band within it to try to share back?
Exactly. We still band within it a little bit, and not a ton. Like I said, it's still a good chunk of the group gets the 67, but what we want to do is make sure that organizations are vested into the program so that it doesn't unravel upon itself. Because what we have is probably not a little bit of a morbid term, but what we call it within the industry is you can get this death spiral within an entity like this if you don't have the proper parameters in place. So basically what that would mean is the organization that comes out and says, well, I would get 6% if I went off on my own of a decrease, well then you start to have those better groups pull away, right? You're left with the more high cost groups, and essentially you get this unraveling of a program. So that's why we've set those kind of parameters up within a lot of these organizations that we've done this to say, all right, we all have to understand that we're in this for the long run, this is a long-term solution to this problem. We don't necessarily want you jumping ship if you would have gotten a better deal in one particular year.
In 1 year.
Well, especially since that same company who had a stellar year, the next year could tank.
Exactly.
And so that's the other part of the argument that helps keep people in the group, because you never know. Question, Brian.
Sure.
This is kind of my bailiwick. So in those 81 entities, about how many covered lives are you talking?
In this organization, there's 16,000.
Okay, so that again gives you a sense of what we're talking about in terms of what we need to garner together. Obviously, the more businesses, the better, but the more covered lives within those businesses is really what drives this. I actually
Absolutely.
used to work for Gallup. I used to work at GSP.
Did you really?
Yeah.
Okay.
Yeah.
There you go. So you can critique me well at the end then. Question?
Yes.
What do you mean by banding? I don't know.
Okay, so basically what I mean is, and to your point, what we've done is, okay, so of the 81 entities that are in this, about 50 or so are going to get this 6.7% increase, right? Then you're going to take a look at about 15 or so that are the highest utilizers, right? What we do is we look at their loss ratio, so what they've paid in compared to what they've incurred in claims. And that higher percentage of groups, we have a banding layer set up that it's plus or minus 5%. So if you're a very high utilizer and you have a loss ratio that is within the top percentage of the overall organization, you're going to get 5% on top of that. If you're contrasting on the bottom side of that and you, let's say, have a loss ratio of 75%, where you're paying 25% more than you really incurred in claims, you're going to get 5% less than that. Okay, so again, we want to keep some level there that every group is not going to have the exact same, because we don't want it to kind of fall on top of itself, so to speak. So what we do is we create a little bit of an incentive there for groups that have had a great year, that they don't have as drastic of a differential between what they're paying through this and what they would pay in the open market.
So nobody's insurance rates are going to go up 25%.
Right.
Right.
Well, and I'm not going to
Well,
promise
you
that.
can't say that
Can I
for
put that in
sure.
writing, please?
Yeah, I'm not going to promise
But
that.
everybody's, would it be a catastrophic, the more lives you have, it had to
Yeah.
have a lot of bad, high
Elliot,
level.
statistically speaking, you're way on the tail to
Yeah.
have that happen. Okay.
Yeah, you really had a bad mix of people then.
Yeah.
Yeah.
You got everybody who's morbidly ill. You know.
Question.
In terms of the program that Elliot's contemplating, and I apologize, I'm coming in the middle and I may have missed an awful lot of stuff. But does this work for the sole proprietor with a couple of part-time employees? And is each being individually underwritten through the program you're contemplating here?
That's a good question. So typically, I know probably what you're referring to is if you get employees to sign up and it's a small group, they take a look, the insurance company will take a look at what the actual health history of those employees are. The idea is once you get to a certain level, and that's why we're collecting the census, the insurance company doesn't necessarily need to know what Sally's health is because they know they have enough employees to spread it all across. So to answer your question, no. And I will get back to your point, Elliot, as well. You know, the idea behind this is, again, get enough size so that you do have a little bit more stability and less fluctuation in your rates. To say that, you know, this is, again, a silver bullet that's going to prevent a 20% increase, I'm not going to necessarily say that, but what I will say is every organization within the EBC has had much more budgetable and much more predictable renewals than they would have had on their own. What we actually do is we go back retroactively with each organization and say, all right, if you were on your own, here's what your renewal increase would have been, here's what it is because you're in the EBC. And not every year are they going to have a better renewal under the EBC than they would out on their own, but what they do have is a much more budgetable trend increase year over year. Yeah.
And within a group such as you're planning here, will there be choices, PPO versus
Great
other
question.
things?
Great question. Every organization, and we can set it up differently, however SBAC wants to do it, but within this organization, every single company has whatever plan design they want, right? So it's complete flexibility. You have one that has a $200 deductible, and you have one that has a $1,000 deductible. And the way that we set this up is because a lot of these organizations have collective bargaining agreements, right? So they need to maintain a lot of flexibility when they go to the table with those unions. So we can, or we also have other associations where they want to make it easier administratively and say, okay, here are the 5 options that you have, right? You have these 2 HMO options, and you have, you know, a $1,000 deductible, a $250 deductible, and a $2,500 deductible. And basically, then you can start to get rates that are a little bit closer, right? Because right here, everybody has their own rates because they have their own plan, and they have that banding formula within each year. Anything else? Any other questions? Good questions, by the way.